So welcome, everybody. Today, I am delighted to be joined by Dr. Chike Emedosi, a lecturer in banking and finance law at the University of Aberdeen. He specializes in the law of finance and has published in leading academic journals, including the Juridical Review and the Banking and Finance Law Review. He is the author of the monograph, The Transfer of Rights in Securitizations, by Eleven Publishing in 2024. His research has been funded by the Scottish Universities Law Institute, the Max Planck Institute, and the British Academy. So, the discussion today we are having is about his really excellent quarterly report done for the Africa Sovereign Debt Justice Network. The title of his report is Development Finance in Africa and the Institutionalized Risk Premium. So, welcome, Dr. Emedosi.
Thank you very much, Professor Gatti, for having me. I would also like to use this opportunity to thank Afronomics and also the African Sovereign Debt Justice Network for supporting this research.
Oh, you're very welcome. We are delighted to be working with you on this report. So, the first question is about the role of credit rating agencies. And we know that that role with regard to Africa and the African debt crisis is now well understood. So my question to you is, what does your report add to what we already know?
Thank you for that question, Professor Gatti. And you're absolutely right to know that the role of credit rating agencies in worsening Africa's sovereign debt crisis is well documented. We know that the lower sovereign ratings, we know that lower sovereign ratings translate to higher borrowing costs. It's a direct correlation, and especially in the Eurobond market, where many African states now raise capital. We also know that most African countries are rated below investment grade. Just to put that in perspective, out of 54 African states, so these are states recognized by the UN, only 3 currently hold investment grade ratings. The remaining 51 are either rated sub-investment grade by the major international credit rating agencies, or are not rated at all by them. And these have very dire consequences when it comes to the cost of borrowing by these African states. So a concept has emerged from this reality, and that is the African risk premium. This is the idea that African states are charged more to borrow, not only because of objective economic fundamentals of the state, but also because of an assumed higher level of risk that is associated with the continent. But the question then is, what are the factors that drive the African risk premium? What factors explain why African states or most African states are often charged more to borrow from international capital markets? And this is the point where my report comes in. So the existing literature largely explains the risk premium in 2 ways. So on one hand, we have the view that suggests that the premium is driven by perception or by market bias. And proponents of this view argue that the higher risk associated with the continent is only a perception that is not justified by real economic conditions and fundamentals. Now, on the other hand, we have an opposite view that argues that the premium reflects real structural weaknesses in the region. And because of that, it is justified. So they suggest that the higher risk imposed on the continent is real, it's not a perception, it is real. Now, my report, and this is the big idea of the report, my report argues that this 2-part explanation of the premium is not complete, is incomplete. In other words, the two drivers that we already know in current literature do not exhaust do not fully exhaust the causes of the African risk premium. The report then introduces a third driver, which it calls the institutionalized African risk premium. And this third driver is not necessarily concerned about um, market bias. It's not concerned about whether the market is biased against the continent or whether the rating agencies are biased against the continent. It's also not concerned about whether there are some structural weaknesses in the region. Rather, this third driver, that is the institutionalized African risk premium, tells us about how the African risk premium has been structurally embedded in global financial regulations. And this is significant because it shifts our understanding of the African risk premium from what the market thinks about African exposures to what the market is compelled to do in relation to those exposures. Now, how did I prove the existence of this institutionalized African risk premium? Now, I did that in the report by examining how current regulatory capital frameworks that are applicable to internationally active banks and insurance companies reinforce the risk premium. So let's take the rules that apply to banks, for example. These rules are mainly based on the Basel III framework. Now, this framework requires internationally active banks to hold regulatory capital in proportion to the risk weights attached to their exposures. So these exposures includes includes bank investments like loans and also investment into sovereign bonds as well. And under the standardized approach of the framework, those risk weights are directly linked to sovereign credit ratings. So what that means is that, given the widespread non-investment grade rating of African states, banks are required to hold significantly more capital against African exposures. And the issue here really is that higher capital requirements increase the bank's cost of providing a loan. And that cost will usually be passed on to the borrower, in this case, the African state that is issuing bonds, through higher interest rates. In other words, the standardized method or approach of the framework embeds the widespread sub-investment grade ratings African states currently hold into the capital rules and make them a formal part of how regulatory capital is to be calculated. Now, this in turn contributes materially to the elevated cost of borrowing or risk premium faced by African entities. Now, the institutionalized component of the risk premium becomes even more pronounced when climate risk is incorporated into capital assessments. Now, banks are required to incorporate climate risk into how they assess risk weights against every exposure. So for every loan that they provide or for any bond that they invest into, banks are required, when assessing how much capital they're meant to hold against those loans, they're required to incorporate climate risk into that assessment. The problem really is that Africa is disproportionately affected by how climate-related financial risks are defined, by how they are understood and also assessed. And this is particularly true when it comes to the physical aspect of climate risk. So physical aspect of climate risk relates to climate change events. If a country or a borrower, or if a project is um, prone to climate change events like wildfires, droughts, flooding, then that borrower will be considered to be riskier and will be charged higher capital against any loan given to the borrower. Now, the physical climate risk are defined by geographical vulnerability. So they're not defined by the nature of the project, but where the project is located or where the borrower is located. Banks need to consider the extent to which the borrower or the project is vulnerable to climate change events, like, as I said, major floods, storms, wildfires, etc. And any risk that arise from that assessment would need to be incorporated into the risk weight that is attached to the relevant exposure. Now, we all know that Africa is widely regarded as exceptionally vulnerable to climate change. Now, do not take my word for it. This has been established by notable institutions. For example, the Intergovernmental Panel on Climate Change has established that Africa is expected to become the epicenter of climate vulnerability. And the United Nations Environmental Programme has also confirmed that Africa stands out disproportionately as the most vulnerable region in the world when it comes to climate change. Now, this makes African exposures particularly sensitive to climate risk and creates what I describe in the report, an African climate risk premium, where regulatory treatment of climate vulnerability of the region further increases capital charges and therefore financing cost. So just want to round up, but I would really like to clarify here. Um, um, I would really like to make it very clear that I'm not in any way suggesting that the science behind the finding that Africa is vulnerable to climate risk is wrong or biased. I'm also not in any way suggesting or insinuating that the Bar 3 framework is biased or discriminatory towards Africa. Now, these considerations are not really relevant to the nature of the institutionalized risk premium. What I hope to achieve with this paper is to show that these risk premiums are not only perceived, or they're not only about what the market thinks of African exposures, but they have actually been embedded into law in a way that markets are compelled to act and add a premium. Yeah, thank you very much for that.
Yeah. So thank you very much. I think the examples that you have given are very compelling to explain your concept, your very original concept of the institutionalized risk premium. Um, and before I just go to the next question, I think I would note that even though you're pushing back against the arguments based on bias and perception or the structural weaknesses, that uh, your arguments and very well supported by the examples um, do indicate that there's a disparate impact on Africa uh, because of the structural elements that are embedded within the rules that are used to assess, for example, the climate risks. But in any event, I want to go to the second question, which is another very important question. So, why are these findings in your report important for those involved in trying to resolve this question of the debt crisis in our continent, Africa?
Thank you for that, Professor Gatti. I think the findings really matter because we cannot adequately solve a problem that we do not fully understand. Um, Take, for example, assume that our understanding of the premium is limited to market bias or the rating agency's bias, or is limited to perception, then our the solution that will be introducing will focus only on reforming credit ratings and also the agencies. And if our understanding is also just limited to structural weaknesses within the continent, then the focus of the solution we'll be introducing will be mainly based on domestic reform, right? Which is also not really adequate in addressing the full extent of the premium. And if we then open up our understanding to also include the institutionalized component of the premium, then we will then see that for the solution that we are introducing to be adequately um, or for the solution to adequately address this problem, there is a need for us to go beyond these domestic reforms and institutional reforms, but also to reach out and discuss reforms as international level. Take for example, looking at the banking rules, it would then it gives us the reason to propose reforms at the Basel III levels or propose reforms in countries where most of these internationally active banks reside in. So it's really important for us to have that full understanding. So essentially what I'm saying really is that our understanding of the risk premium is limited. Sorry, if our understanding of the risk premium is limited, the solutions we propose to address the premium may fall short. And I appreciate that this has some implications for initiatives like the proposed African Credit Rating Agency. The agency, I believe, can play a leading role in addressing the perceived component of the premium. So this is the premium that relates to market bias and the credit rating agencies bias. So I believe they can really be very effective in addressing that problem, that side of the problem. However, I think that the agency has a limited role to play in addressing the institutionalized components of the African risk premium. Now, don't get me wrong. This is not a criticism of the agency. As I've noted in the report, the agency has a strong potential in addressing the perceived component of the premium, and I really encourage the African Union and the APRM to keep up with the good work. But rather, what the report reflects is that the risk premium problem is multifaceted, and addressing it requires interventions on various levels, both at the domestic level, national level, and also at global levels as well. Thank you.
Great. We didn't plan it this way, but as you know, the theme of the reform of the global debt and financial architecture is a major theme of the Africa Sovereign Debt Justice Network. And I think your report falls in that grand tradition of the Africa Sovereign Debt Justice Network and Afronomicslaw. So my next question is on some of the elements now within your argument. You argue that the Basel III due diligence requirement cannot reduce risk weights below external ratings. What specific amendment to the Basel framework would you propose to correct this asymmetry?
That's a very important question. And let me begin by saying that the due diligence requirement under the Basel III framework is prudentially sound in its intention. One of the major lessons we learned from the global financial crisis was that was the danger of banks over relying on external credit ratings from external rating agencies. And it turned out that these ratings were deeply flawed, especially in relation to structured products. The due diligence requirement was introduced precisely to reduce that over-reliance and to ensure that banks conduct their own risk assessment rather than outsourcing, judgments relating to prudential assessments entirely to external um, rating agencies. So the objective of the rule, I think, is sensible. The issue I identified in the report, however, lies in how the due diligence requirement operates in practice. So under the current framework, the outcome of a bank's due diligence, so if a bank nominates, take for example, an external rating agency, the bank nominates their rating for the purposes of calculating how much capital they're meant to hold against a particular exposure. The banks are required to carry out their own due diligence and not just rely solely on the judgment of that external credit rating agency. So, um, so when banks conduct their own due diligence, the outcome of that due diligence cannot result in a risk weight that is lower than the one implied by the external credit rating agency. In other words, the due diligence exercise can push risk weight upward, but it cannot push them downward. Now, what this means is that the rule preserves it preserves a flaw that has been created by the external rating agencies. So even if a bank believes that a particular African sovereign exposure is less risky than an external rating suggests, the framework prevents the bank to apply a lower capital relief on that exposure. And from the perspective of the institutionalized risk premium, this asymmetry really matters because it means that even though banks are required not to rely on the ratings of external agencies, if their due diligence results in, if they think, wait a minute, I think this country should have a better rating, and then a lower capital requirement should apply to this country based on our own due diligence, the bank is not allowed to lower the capital requirement than the external rating agency suggests in their rating. And it is for that reason that I I I think that that asymmetry really matters. Now, one possible amendment would be to make the due diligence requirement less conservative because it's currently conservative given the flaw that it has. So I could say, okay, let's amend it so as to make it less conservative and to allow banks under, of course, strict supervisory oversight to assign lower risk weights where there is robust evidence, to support or to believe that a particular sovereign um, is more creditworthy than their rating suggests. So I could just say, let's do that. But I recognize that there is a possible counter argument that may flow from that. Because a more liberal framework could be abused by banks and could then reintroduce the very problems the Basel III framework was designed to correct, which is the underestimation of risk and the erosion of capital buffers as well. And this in turn would then undermine prudential stability or financial stability. For that reason, I do not think that the most sustainable solution lies in simply loosening the due diligence flaw. Instead, I find a solution elsewhere, which is within, how risk is being calibrated. And in the paper, I propose the solution that responds to the African climate risk premium that I mentioned earlier. And this solution proposes the introduction of a capital reduction factor in the way risk weights are calculated for high quality climate friendly loans that are going into the continent, or for high quality climate friendly bonds that are issued by a country or an entity in the continent. And this has the potential of lowering the amount of capital that banks are required to hold against, loans flowing into Africa. So that would be my preferred solution. So rather than amending the due diligence flaw, I would rather find a solution within how that relates to how the climate premium risk I identified earlier is addressed.
Great. Yeah, that's very insightful. I mean, just as a footnote, maybe for the listeners who will listen to this recording later on, I wonder whether maybe that argument could be even supported. The argument of how you would go about rejiggling the framework to resolve the institutionalized aspects that you identified. Whether whether somebody looking at this from a UN human rights guiding principles framework might support your argument about how to think about due diligence when there is robust evidence that the risk is actually lower. To come to the same conclusion. But I know this is not your argument. I can see a lot of potential for that framework to be useful as an external rebalancing, whereas you are doing it from the inside.
Mhm.
But my question, which is really the last question, you can comment on that if you want. But my last question is on your proposal for this climate supporting factor. It seems to resemble the EU's green supporting factor debate. How would you prevent such a factor from undermining prudential soundness while still reducing Africa's climate-related capital burden?
Yeah, thank you. Just to react to your previous question about the human rights side of things when it comes to the due diligence flaw. One thing about the regulatory capital regime is that it is risk-based. Um, it is not really open to the question as to whether it is fair or not, or as to whether it is morally sound or not, but it really responds to financial risk. So for every exposure, how much risk does this exposure have? And how much capital should the bank hold against the exposure? And it is really, really risk-based. And the way risk is understood within the framework is has is duly explained in the framework in order to make it to be more sensitive to financial risk. So even if on the human rights side of things, even if the approach within the Basel 3 framework may not go well with the human rights side of things, these are completely different regimes.
Yeah,
And
I agree. I mean, sorry to
yeah,
cut you, but all this is based on human judgment. These
yeah,
assessments are not, these formulas are not fixed formulas. They are all designed based on judgments that have to be made, even
yeah.
though they do, as you correctly say, strictly follow the rules.
Mm.
But still, these are all judgments. It's not as if um, they are um, they are established by any other means other than by human judgment. And
Yeah,
the
true.
human rights framework, when it comes to due diligence standards across many areas, as you
Mm.
correctly know, um, is simply asking um, for certain considerations to be taken into account, very much the same way that um, you are making the case for a climate supporting factor. But I know I know this is not your argument. I was simply making an observation. Maybe
Okay.
the listeners might be provoked by your excellent work because I think it does really open up a really important um, discussion
Mhm.
that is also very informed by a very high level understanding of the technical aspects of the Basel III framework.
Mhm.
So, I perfectly understand you. I'm sort of being provocative here.
That's fine. Of course, we can have this conversation, after now, if you want. Sorry, can you come again with your question? I think
Yes, sorry. Yeah.
it
So
escaped my mind.
this your proposal for a climate supporting factor
Mhm.
resembles the EU's green supporting factor debate.
Mhm.
How would you prevent such a factor from undermining prudential soundness while still reducing Africa's climate-related capital burden?
Yeah. So I agree that what I'm proposing looks similar to the EU's green supporting factor debate, in the sense that both um, tries to use capital rules to influence incentives. Um, but they respond to different problems. Both of them respond to different problems. So let's take the EU green supporting. So let's take the green supporting factor debate, for example. So that's supporting factor was primarily about encouraging banks to shift capital into green assets. And that is partly to correct the imbalance, as it was then, where brown assets where brown assets can look more attractive to banks because they are more established and, if you like, more profitable. Um, so the factor was being introduced so as to, encourage banks to fund green assets. And the difficulty, as regulators, have repeatedly pointed out about the green supporting factor, um, is that you cannot really assume that green assets are automatically safer than brown assets. So when I say brown assets, I mean projects that are somehow connected to um, CO2 emissions, right? Um, the difficulty with the green supporting factor is that green assets are not necessarily safer than brown assets, right? And if you reduce capital charges, simply because an asset is green, so the asset is because the asset is climate friendly, you risk weakening capital buffers for banks and undermining prudential soundness, right? Now, the African climate supporting factor, which is the one I'm proposing, is different from the green supporting factor. It is different because it is not premised on the claim that green projects are inherently low risk. It is designed to correct a potential imbalance I identified in the report, which is the African climate risk premium. So, as I've mentioned, Africa is disproportionately disadvantaged by how climate risks are understood and also how they are incorporated into risk weights under the Basel III framework. And this creates what I call um, um, distributive consequences in the world of scarce capital, right? So it's basically because of the high capital charge that arises from the way climate risk is understood, because of the high capital charge, it has a potential to push finance away from the continent, the very place where we actually need finance to fund mitigation and adaptation to climate change. And this is really where finance is urgently needed. Um, so this has that potential to either drive finance away or make finance to be highly costly for African states. So how do you prevent this from undermining prudential soundness? So how do we prevent the African climate supporting factor from undermining prudential soundness? Because that is really the main concern. And the answer really is that we can design it like a prudential tool and not a blunt incentive, right? Um, the supporting factor should apply only to qualifying exposures that meet strict and verifiable criteria. Um, so the adjustment does not attach to risky lending, but to very high quality lending that is being penalized by because of the way climate risk is understood um, in the continent. So a useful analogy here would be the EU's infrastructure supporting factor approach. This EU approach allows a reduction in capital requirements for certain infrastructure exposures within the EU, but it only applies where the projects meet certain strict quality and risk criteria. And the key idea here really is that the supporting factors can be designed in a way that remains consistent with prudential objectives, in a way that it doesn't undermine prudential soundness. And I will also want to, make it very clear here, as a in summary, that the supporting factors idea already exists. For example, just as I've mentioned, we have the EU infrastructure supporting factor, which has been in existence for years. We also have the EU SMEs supporting factor, which applies to small and medium enterprises. That too has also been in existence for years. So I'm not actually asking for something that is alien to the regulatory regime. I'm actually asking for something that other regions have tried and so far seems to be working from the side of not undermining prudential soundness. Thank you.
Excellent. This has been very good. Your quarterly report, Development Finance in Africa and the Institutionalized Risk Premium, is a really important addition to understanding of this problem that Africa faces in borrowing. And I thank you so much for writing such an important report, for taking the time to answer my questions today. Our readers and listeners will be able to download the report at Afronomicslaw. There is the cover of the report that can be downloaded at afronomicslaw.org, and it's going to be under our repository tab on the website. So thank you so much, Dr. Emedosi. This has been a fascinating conversation, and I think our listeners will also not only learn from this and be challenged to carry this work forward based on the new pathways that you have established. So thank you very much, and look forward to continuing to work with you on these important themes.
Thank you so much for having me, Professor Gatti. And again, thank you also for to Afronomicslaw for the support that I've received in the course of this research. I just want to quickly add that the institutionalized African risk premium can manifest, in different ways. So I've tried to show its existence by examining the regulatory capital regime that applies to banks and insurers. But then it can also manifest in other financial regimes, and I would really encourage people, with interest in this area to please further and interrogate these other regimes and see how how these premiums can also emerge in those regimes. And thank you again very much for having me.
Thank you. Thank you. Very, very good idea. I'm sure you'll be hearing from people who want to carry this idea forward, maybe even to do master's degrees and write PhD theses,
Yeah, I'm very willing to advise or even supervise candidates on PhD or even LLM research on this topic as well.
including our very active academic forum that's led by Professor Ohio.
Of course.
Yeah, we have lots of young people who want to be as good commercial lawyers as you. So thank you again, and all the very best to everybody.
Thank you. Bye.
Right. Bye bye.